Good afternoon, everyone. Thank you for joining us today. I appreciate your time, and for those of us that are returning from our last session Friday, thank you very much. Today we're going to talk a little bit about the credit market. I think it's a very applicable topic given what's going on in the world. I think maybe in the next couple of days we can talk about how oil can trade at negative $40 at one point last night. But for now, let's look at what's been happening in the credit market and where we're off to. So the agenda for today, the things we'd like to cover is just what has been happening in the search for yield the last couple of years, understanding what's been happening to the credit spread over that period and what's been happening over the last month. And then Corneleo will take you forward and talk to you specifically about just the concept of credit risk and what we're going to be doing about it and everything else that you may want to add. So what's been driving yields in the markets the last couple of years? So what we have on the screen is effectively the size and fund flows of various couple of the primary unit trust classes or CIS categories in South Africa. So on here we have general equity, we've got IB short term, and we can see how, specifically, right, we've seen significant flows to the short term interest rate bearing market. Now, for those of you that invest with Ashburton, we have two funds in that space. The one fund is called Ashburton Stable Income. It's our largest fund. It's sitting at just over 16 billion, and it's seen significant support over the last couple of years. And the other one is the Ashburton SA Income Fund. Now, there's been a variety of reasons for the inflows into these categories. One is that equity returns have not been exceptional over this period, specifically in the 2016 to 2019 time. And also with inflation low, interest rates high, and credit spreads relatively attractive, you could get quite close to CPI plus 3 to CPI plus 4 by investing in what effectively amounts to a low risk cash and credit portfolio. Now, as you can imagine, supply and demand changing and increasing significantly in the credit market has had a bit of an effect. So you can see from 2016 through to 2018 how both the amount of listed assets and the amount of assets in the interest-bearing short-term category has increased significantly. So there's both been an increase in listed credit assets, but also an increase in the amount of money chasing those assets, right? So that had an interesting effect. All credit in South Africa effectively prices relative to something else. And most of the instruments that we're talking about today are floating rate notes. And those floating rate notes price relative to something called JIBAR. Now, JIBAR stands for the Johannesburg Interbank Acceptance Rate. It's effectively the corporate version of the prime rate for people, for individuals. And you can see that from 2016 to 2017 to 2018, 2019, and the start of 2020, the rate that you could get by effectively giving debt to the big five banks, right, dropped little by little every year. In 2016, that number for 5-year debt was close to JIBAR plus 180. In January and February this year, that number was just under JIBAR plus 130. To give you an idea of where JIBAR sits at the moment, as we speak, JIBAR sits at about 4.6%. At the end of last year, JIBAR was close to 2.5% higher. So if you think about JIBAR plus 130 in the current environment, that would give you approximately 6% return on 5-year senior bank credit on a floating rate note basis. You can see that was not just true for senior bank debt. If you look at what's been happening in the various other areas of bank debt, you will see that the senior bank debt's fallen. The yellow line, which is tier 2 bank debt. Tier 2 is effectively sub-debt in banks. And then the gray line is additional tier 1 debt. Now, additional tier 1 is effectively bank debt that replaces the old preference shares. So if you think about what a bank capital structure looks like, right at the bottom, the most risky asset class for or participation for a bank is equity. Above that is this additional tier 1 debt. Above that is tier 1 debt, and above that is senior unsecured debt, right? So the pricing on senior unsecured debt we've discussed. Bank tier 2 debt was pricing at around about 400 basis points, JIBAR plus 400 in 2016. And additional tier 1 debt was pricing at JIBAR plus 700 in 2016. And that dropped off all the way to the start, to February 2020, when tier 2 debt was pricing at just over 200, and additional tier 1 debt was pricing effectively at between 450 and 500. So there has been several supply and demand dynamics, right? Since the middle of March, however, credit in South Africa is traded differently, right? There's been a sudden demand for liquidity, which has led to spreads increasing, and this was focused on only certain sectors of the market, right? So if we go to slide 8, we'll see that in action, right? So there's about, and we looked at about 800 instruments. There's about 800 instruments listed in that are floating rate notes, which is the type of instrument we're looking at for now. Of those 800 instruments, between 600 to 700 instruments, so just under 650 instruments, saw no change in their spread from the 15th March to the 15th of April, right? So they were still trading middle of April where they were since the start of March, right? And about 160 instruments did see changes in their spreads, right? So, and in other words, if you think back to our example on bank credit paper, some of these instruments had spread increases, instruments may have had spread decreases, some of them may have matured. But about 160 instruments on the JSE, spread was different on the 15th of April compared to the 15th of March. If you think about that in equity terms, it would be like in the top 40, about 25%, right? So only 10% of shares having seen a change in price, with the other, or 25% of shares having seen a change in price, with the other 75% still trading where it was trading a month ago, right? That's the closest example that we can look at. And the reason for these primary changes in price is that people have been looking for liquidity. Now, what does that mean? Where does that come from? If you think about the example of, let's say, the average balance fund, right? In April and during March, two types of things occurred that was likely to lead to search for liquidity. One is that some of these portfolios have seen outflows as clients look to redeem their money in times of crisis. We do know that that is what a lot of investors do during that time. We tend to advise against it, but we also understand that it happens regardless. So balance funds and most risk funds have seen some outflows, so people need to sell assets. Secondarily, if you look at what's happened in the market and what looks like on a forward return basis, is that the potential return on credit assets have dropped a little bit because repo rates have dropped. At the same time, the rates of return on things like bonds, offshore assets, etc., have increased because of the sell-off in the equity markets, right? So if you're a balanced fund manager and you were underweight equity or neutral equity, it's likely that during March and April, you were selling things like credit and cash and increasing your riskier asset classes to give you a higher forward return basis. The problem, however, is that only a certain type of credit instrument is really liquid enough to trade in the market. And this is the details on it. On slide 9, you can see I've listed all the institutions that have seen changes in their credit spreads, as well as the average change in the credit spread by all the various instruments listed. So all of these institutions, from ABS at the top to Vukile at the bottom, had at least one instrument that changed price at least once, right? So you can see at the bottom, Vukile had an increase in spread. One of the instruments had an increase in spread, same with Discovery, same with several others. But if you start looking towards the top of that list, you'll see that when it comes to Absa, Nedbank, Standard Bank, and FirstRand, they all have seen several instruments that have increased in spreads. In fact, when you start counting that up on slide number 10, right, you will see that of all spread changes in the market over the last month, effectively from 15 March to 15 April, of all spread changes over that period, 60% or 100 spread changes can be accounted for by moves in the prices of the big five banks, right? Whereas all other instruments listed on the JSE combined accounted for only 38% of the spread changes, right? So what is happening here? It's effectively people selling things that can be sold, right? It's saying, well, we know, both the seller and the buyer knows that the African banking industry is very solid, right? The Reserve Bank has taken significant steps to maintain both liquidity in the banking sector, as well as taking several measures that have helped the banks with their profitability, that has helped banks with liquidity, interest rates, helping in the repo window, etc. Right? So effectively, what it means is that to a large degree, both the buyer of credit and the seller of credit realizes that the big five South African banks are some of the safest credit that you can buy in this market. So when you have to sell something, a good option is to sell something like this. And at the same time, on the next slide, it doesn't quite tell you the whole story, because we look at a 1 month period and we look at a start point and an end point and we say, well, this instrument has traded at least once and has seen at least some changes in spread. But if you look at this specific instrument on the screen, this instrument is called the FRJ25. It is senior bank debt issued by FirstRand that matures in 2025, right? And as you can see there, every red circle was a change of day price where there was a change of spread where there effectively was trades occurring in the market. But even though there was at least 5 times since effectively the 15th of March when FRJ25 changes in spread, we only saw or only accounted for it once, because we only use a start point data and an end point data. And many of you that have seen some volatility in some of your cash and credit portfolios, this is the reason. If you look at this senior bank debt instrument that has changed hands several times and you can see the significant variation in price, this is why we've seen some volatility in portfolios that have not historically seen a lot of volatility thus far. Ironically, what this means is that portfolios that were invested in safe, secure bank paper has actually seen more volatility than portfolios that were invested in purely listed credit that were issued by organizations other than the banks. So some of the safer portfolios, like Ashburton Stable Income, for example, saw some daily volatility, not because there were credit events, not because there's concern about the underlying credit, but because pricing and search for liquidity has effectively caused price changes in the markets. On slide 12, you can see what I mean around the credibility and safety of these instruments. Right? So on the left-hand side, we have a calculation from Bloomberg, which gives us the 1-year probability of default of FirstRand Bank. And the 1-year probability of default is 0.2%. Right? So in other words, 2 times in 1,000. On the right hand, we have the 1-year probability of default of Goldman Sachs, also according to Bloomberg, also 0.2%, also 1 time in 1,000. So if you look at these two banks, right, neither of them have a high probability of default. FirstRand ranks right up there with one of the best known banks in the world, and yet we've seen some of their credit trade through to -5, -6% relative to par. What this just underscores again is that the credit spread changes that we've seen in the market thus far, and that we are still seeing to a lesser degree at the moment, has been primarily a function of a search for liquidity rather than trades due to fears around credit risk, right? So as a final slide before I hand over to my colleague, Corneleo, is just as a quick summary. The moves that we've seen thus far, right, have been as a function of a search for liquidity. It's not been as a result of credit events. It's not been as a result of fear of default, right? The moves are largely extremely concentrated in the banking sector rather than being more broadly based. So ironically, portfolios that are invested primarily in listed bank debt have seen more moves than those that are invested, say, in other types of corporate debt. And then the net result of all of this is that, similar to the way when a bond reprices down, it has a higher yield. When these credit spread instruments price down, is that they give higher yields to the portfolio. So all of these instruments are now pricing at higher levels. So if you think back to the levels where we were showing where prices and spreads of banks have traded since 2014, is bank senior debt, tier 2 debt, and additional tier 1 debt is now trading back at levels that we last saw in 2015, 2016, depending on which instrument you're looking at. So if you look at just purely bank debt, suddenly you are capable of getting higher returns than you would have normally. I'd like to hand over to my colleague Corneleo. He will go ahead with the presentation further.
Okay, good afternoon, everyone, and thanks for joining us and making the time to listen to us. I'm sure you have lots of questions, so I'll be quite quick through what I wanted to cover in the slides. I think if you look at the first slide, what I think is very important is to just look at credit as an asset class before, from a fundamental perspective. I think when you look at credit, the best place to start is at the capital structure of an entity, and that's on the right-hand side of the slide. So if you had to think through a liquidation scenario, I think it's important to note that your normal common equity, which is the shares that are listed on the JSE, that's the element in the capital structure that's the most back ranked. After that, you get your preference shares, and then after that you get mezzanine debt or subordinated debt, and then you get into sort of the credit that we're talking about today, which is your senior type credit. Now, senior credit can either be secured or unsecured. If you're a senior unsecured lender, then essentially you have the same claim as any other senior creditor on the business if there is a liquidation event. If you're a senior secured creditor, however, there are specific assets that has been ceded or pledged to you as security for you providing them the funding, or the counterparty the funding, and you as a lender would have first right to any proceeds realized from that asset in the event that it is sold to try and recoup debt or try and settle debt. So hopefully that gives you an idea of sort of where you rank as a credit investor if things do go wrong. And there's a few reasons why this concept exists. I think firstly, if you are a credit investor, as you're fully aware, you get a capped upside in your investment return in exchange for being a senior ranking creditor. And that really is you're willing to put up with that capped upside because there's more certainty during times like these, times of uncertainty, that if things go wrong, you're likely to get more cents in the rand back if a business had to go into liquidation. Now, with that being said, of course, there is the risk that you can lose all your capital, but for that to happen, everyone ranking below you in the capital structure would have also had to write off their entire investor as well, or the entire investment as well. So I think why are these things? I think when you look at that, obviously you've got a capped upside. So your returns are capped and your returns are lower than what you may expect over time from an equity investment. It becomes important to try and isolate those credit loss events if they do occur. So that's why when you do run a credit portfolio, it's important to build as diversified a portfolio as you can. Look, I think when things go wrong, and obviously these are difficult times, you're obviously going to see companies taking or seeing a decline in their earnings. But there's quite a few levers that companies can pull before they can no longer service their debt. And if you think about items such as cutting costs, passing on dividends, as we've seen quite a few corporates announce since the outbreak of the coronavirus, and also a delay in capital expenditure. So those are all items that are used by lenders or by borrowers, to conserve cash, to make sure that they can actually service their debt obligations as and when they fall due. And I think the other thing that does help from a credit perspective is that you ultimately rely on cash earnings to be settled. So where there are large impairments, even though it may impact earnings, it might not necessarily impact cash flows per se, and it may not necessarily impact the ability of the corporate in the near term to service that debt. I think finally, which is a point that Albert made, and hopefully it's something that you took away from his presentation, is that credit in South Africa, whether it's listed or unlisted, is quite an illiquid asset class, especially when things go wrong. So when you do take the decision to invest into credit, the team has to be quite comfortable to look at it on a buy and hold basis. And to be honest, I think that is something that Ashburton does. Every credit investment that it makes, to be sure that we understand the long-term ability of the business to ultimately settle its debt, to be able to refinance its debt over the long term, but obviously with an ability to also withstand some short-term pressures as we're seeing today. I think just summarizing what I've discussed here, there are two examples or a few years ago where the ranking in the capital structure is actually quite well explained in how this played out. So the first one, and obviously these items have been spoken about a lot, but the first one is Steinhoff. You would all recall the challenges that Steinhoff faced in 2018. There were issues around governance, massive issues around governance, intangible assets, profitability, etc. So there were massive concerns around Steinhoff at the time. Steinhoff had quite a lot of debt sitting at its international holding company level, but also it raised debt in South Africa at a Steinhoff South Africa level. What's important there is that lenders all had to, so there were covenants breached, there were events of default, so lenders did have the ability to call up their loans and demand immediate repayment. But if lenders did that, there would obviously have been a massive liquidity squeeze on the business, and there would have been an inability from Steinhoff to actually find the funding to settle those exposures. So lenders had to get into a room with Steinhoff, with advisors, with a whole lot of lawyers, and work through what went wrong and how we're going to solve it. Excuse me, I've got a sneeze building up, so hopefully it doesn't disrupt us. But I think the benefits that we had as lenders in the South African business is that we had a guarantee from the Pepcore operations, which are the Ackermans operations and the PEP operations. And we also had a guarantee from the entity that held some of the listed investments that Steinhoff had. For instance, their shares that they own in CUP, in PSG, etc. And working with one another, working with the company, working with the international lenders, we actually were able to get fully settled as South African lenders. Obviously, it was over a protected period of time, but I think that is a great example of how the capital structure should work under such circumstances, where your senior creditors did get settled in full first. And obviously, we understand that there's still massive losses that are being incurred by the equity investors that invested at the peak of the share price. The next item I wanted to cover was African Bank. So obviously, in 2014, African Bank entered curatorship. They had senior unsecured funding. They also had subordinated funding. I think you could probably put that in the same block as the mezzanine, which we had on slide 14. But they had But there again, if you can recall, they separated the old African Bank assets into a good bank and a bad bank. And what they did is they moved the good bank and the majority of the funding of the old African bank into this new entity, which is the African bank we know today. But what was interesting there is what was agreed is that senior lenders received a 90 cents in the rand recovery, essentially, by being allocated 90 cents in the rand of the exposure going to the good bank, and the rest of the exposure going to what is I suppose, in terms referred to as the bad bank, where the subordinated lenders, because they technically only had a right to settlement after the senior lenders were settled, they only received, I think it was 37.5% exposure to the good bank, with the balance being to the old bad bank. And again, there it just plays into, obviously you earned a higher interest rate on the subordinated loans, but when things did go wrong, your recovery at the end of the day was better on the more senior ranking instrument. So that's hopefully giving you a little bit of comfort with all the turmoil that's going on in the markets in terms of where we're seeing risks emerge. So what have we seen from our client, or what have we seen from borrowers in the market? So we've seen a number of corporates announcing reduced profitability, reduced liquidity levels. And obviously, if you think of financial covenants, so not all bonds would have financial covenants, but loans certainly do. And if you think of the large corporates in South Africa that do issue bonds, majority of them have their major funding with the South African banks in the form of loans, and those loans do have covenants. So chances are a large corporate issuer has got financial covenants, even though it may not be on the bonds. So what we've seen and with financial covenants is these are typically set at a leverage level where you look at the net debt relative to the EBITDA of the entity, as well as the ability of the company's EBITDA to cover its net interest expense. So those are the two most common covenants you see in the sort of normal corporate space. And then on the real estate investment trusts, or on the REITs, the covenants would more be your loan to value, which is obviously the quantum of your debt relative to the value of your assets, as well as the interest cover ratio there as well. Those are all measured on a 12-month rolling basis. So as you can imagine, corporates are experiencing quite a lot of pain from an earnings perspective. And if you have a 2 months, or let's say between 1 and 3 months of very weak earnings, those earnings are going to be in your covenant calculations for the next, call it 12 months. So I do expect we're going to see a number of covenant breaches, or what you may find is corporates approaching their lenders and their debt note holders to waive those covenant breaches in anticipation of a potential drop in earnings. That's one of the things we've seen. What we've also seen is that there may be a strain on liquidity. So we are either seeing corporates approaching lenders and investors to waive potential capital repayments that are due, or even ask for a deferral of interest payments, to try and shore up liquidity to trade through a very uncertain environment. I think, these are, so when you see announcements like what we saw with regards to the land bank yesterday about an event of default, I think you're going to see potentially some more of that, or you may see companies put out SENS announcements saying that they've engaged with their lenders and they've obtained waivers in anticipation of potential covenant breaches. So those are the types of events that you have to look out for. I think what will the requests be? So the requests will be those types of waivers, those types of interest and capital deferrals, and we also potentially seeing corporates drawing down on some of their committed facilities that they may have with their banks. Now, just as a high level, I think before I go into the approach of Ashburton during these times, is just how lenders in South Africa as a whole, or to a large extent, have acted when there's been trying circumstances. I think Steinhoff was a great example. You had a large number of South African lenders, banks and institutions such as ourselves, sitting around a table working together to maximize recovery and not to lose capital. And I think some of the other names where you would have seen that is, there's been quite a few announcements by companies such as Tongaat, around some of the challenges they've faced. It's just typically what you see is South African lenders are quite patient. They are, let's say, willing to work with a counterparty that may be in distress to try and understand what led to the events, and they're quite patient to sort of work with that company to try and understand how do you get to a solution that enables the entity to continue trading, which ultimately then is a better way for lenders and debt investors to make a full recovery on their initial capital outlay. So that's largely the approach we've seen, and I think if you also look at some of the announcements that the banks have put out, whether that be with regards to retail or some of their corporate clients, is that there's likely to be support from banks for their clients, especially if those clients were in good standing leading into the COVID-19 crisis. Obviously, there are names where we were concerned beforehand, where it may be more challenging. But generally, if you had companies that had stable sort of earnings, acceptable gearing and leverage metrics, then this is an event that we would have to sort of try and see how we work through these events. So this leads me to my last slide, sort of what has Ashburton done in terms of its credit portfolio. So I think the first thing we do is when we are asked to make any kind of decision in a credit event, we need to first act in a way that is which protects the capital that we invest on behalf of our clients. That's always a major focus, is to make sure that we recover the capital to the best extent we can. We had a look early March at some of the sectors that we have exposure to, and we allocated corporates to the sectors. We also try to understand how we think the social distancing phase will impact corporates, but also then the lockdown, and so we could try and understand where we see the pressure points, or where we think more pressure points will come, and where we think entities may have a bit more flexibility to deal with the challenges we have. And then we also looked across industries, not only the high risk industries, but we looked across our portfolio to see which corporates are potentially sitting with a leverage problem or a liquidity problem that will limit or inhibit their ability to trade through a protracted lockdown period. So once we've identified those corporates, I think we've tried to sort of establish a continuous channel of communication with those corporates to try and understand how they're looking on liquidity, how are they operating, what measures are they putting in place to conserve cash from their side? Are shareholders potentially looking at providing liquidity during this time, or how are they looking? How are they working with all of their different funders and stakeholders to try and make sure that they remain operational and try and limit the impact of the lockdown on their operations? And I think that's then where we to understand what is the long-term prospects of these businesses. So once we go out of a hard lockdown as we're in currently, it's still going to be a period of uncertainty. So we need to understand how are these corporates going to trade, let's call it 6 months, 9 months, 12 months out from once we're done with the lockdown phase. And those are ongoing scenarios that we try and understand through communication, through our own internal analysis as well, to just see what the prospects are for the industries, but also the counters we have exposure to. I think then finally, where we do get the requests, as I've highlighted in the previous slide, is to say we have a very experienced credit committee and a very experienced team of credit analysts. So we have to do a detailed analysis of every request that we received. It's not just something that we will sort of just approve. I think we have to obviously go and do quite a bit of work to understand the liquidity of the business, to understand sort of the underlying value of the business once they get through this process, and try and understand what other stakeholders are doing. And then we have to go and present that to our internal credit committee. And that Ashburton Investments Credit Committee is a combination of executives within the Ashburton business, but also some non-executives outside with lots of years of experience. They've seen a number of market cycles. I think they've got a lot of institutional knowledge to deal with these kinds of situations. And that ultimately is where the final decision is made in terms of supporting a business through this. Do we support them for 3 months? And then reassess? Do we give a 6-month support? Those are the kinds of decisions that are made at our credit committee level, and which we then sort of implement in our different portfolios. But hopefully that's given you some insight into what we've seen in the market, how we think some of these stress scenarios will play out, and how Ashburton is working with the exposures that we have in our portfolios to ensure that we protect the capital that we have invested on behalf of our clients. I wanted to leave it there because I think we should probably move towards questions, and I wanted to leave some time for that. So I'm just going to have a look at some of the questions here. Okay, so the first one is a request for the slides. I think we'll speak to the marketing team about that. Albert, I think there's a question around you, or between the two of us, we can take it. The first question is with regards to an explanation of repricing of less liquid credit and how that would occur. I think the view there is that prices would be less volatile until a change is executed. So that's exactly correct, and I think that's the message. And Albert can chime in here if he's once I'm done. But I think that's exactly the message that Albert wanted to bring across is that the more liquid sectors such as banks, especially would have been more volatile in terms of mark-to-market movements, just because it is the more liquid instruments out there. I think there's been very infrequent trades in the corporate market, so it's probably quite stale. I think the one thing we've seen in the corporate credit market, and this has been through a number of sort of events, is where there's negative news about a counterparty. The liquidity completely dries up on that exposure. So it doesn't reprice. So it actually becomes quite stale. And I think that's one of the challenges we have in the corporate credit market. But yeah, I don't. And then again, I agree. If there are trades in that paper, you will probably find that it could be relatively large movements in the spread, because it may be someone that's a forced seller on the one side and someone that's doing an opportunistic buy that may have liquidity to take advantage of those opportunities on the other side. But Albert, I don't know if you want to add anything.
So to add some further information to that question, there's technically two ways that a credit can reprice the market. The one is when a trade goes through between two different counterparties. And the other one is a bit of a technicality where if someone puts up a price at which they are willing to buy or sell credit, and the market closes at that kind of level, in other words, that price is up for a long enough period and it's up through the close of the trading of that day, then some of that credit can reprice as well. But in practice, most of credit repricings occurs on trade. And then when you say a large move, credit markets are inherently significantly less risky than other types of markets. So, for example, if a 3-year instrument, a 3-year credit instrument, spreads go from JIBAR plus 150 to JIBAR plus 250, right? You could expect to see a move in the order of, let's say, about 2% down, right? Approximately. So something no longer pricing it at 100% or at 100 cents on the rand, but at 98 cents on the rand. So a 2% down move. Those kind of 1%, 2%, 3% moves, and in some of the cases, maybe up to 5% moves, are kind of really big moves in our market. I get made fun of a lot by the equity people in Ashburton when I complain about the 2% moves in credit. But that's kind of what big moves look like for now. The reality is that when credit starts moving away from this rush for yield, more towards an occasional credit trade, it's likely to have significantly less of an impact on the portfolios. The primary reason for the volatility at some points in a lot of these portfolios has not been a trade, but 15 different credit instruments repricing on one day. If we now just see in the next couple of weeks a instrument or two, maybe three, pricing down maybe 1 or 2%, that has a very, very small effect on funds like stable income, where most instruments that we hold have a weight of between 0.5 to about 2%. So if you can think of, let's say, a 1% instrument moving 1%, that's a very, very small portfolio effect. So even though those prices are relatively large, or for credit, the portfolio effect on liquidity pricing is unlikely to be as severe in the next couple of weeks as it has been in both March and in April. Thanks, Corneleo.
Yeah, sorry, I'm just battling here with my mute button. So we've got another question we've got one or two questions on the land bank. Obviously, with the announcement yesterday that there may have been an event of default under its note program or on its bonds. So there's a question around the exposure. I'll let Albert deal with that on the portfolio side. But in terms of whether we think the SARB will bail them out, I think you have to, I think the SARB is in a difficult position. It's probably not the SARB. It will probably be sort of National Treasury, who is the ultimate shareholder of the land bank. I think, there's a number of SOCs that are sort of self-sustaining, and I think the land bank was really seen as one of those sort of leading up to the COVID-19 impact. So I think what they've expressed in their SENS announcement is that it's liquidity challenges that they were facing. They had a revolving credit facility where a payment was due, and it seemed that they didn't make the payment in time. So that would then trigger an event of default under that revolving credit facility. So because of that event of default being triggered, the note program has from which the land bank issues its bonds has a cross default clause. So if there is an event of default suffered by the land bank on one of its other loans higher than a certain amount, that would then trigger an event of default on all the bonds in its note program. Now, look, I think the land bank they have started communicating with investors. I think they are communicating with, they've indicated that they are working with the lender as well, where the event of default took place. So there's a bit of uncertainty in terms of if the lender that has the RCF with the land bank, if they waive that event of default, it may well be that no event of default will then have occurred on the notes, but we are sort of taking up legal advice on that just to confirm our position. But again, I think that's an example of a business where you probably have a number of the land bank has a commercial book, and they also have a developmental farming book, and they have different collection profiles, and you may find that they experienced some stress in their collections during April, and that would have impacted their liquidity. And I think that would probably be the reason for them not making the payment due on the RCF. Look, I think they will engage. I think they're already engaging with their shareholder as well. And just given, I think, how strategic the land bank is in the agricultural sector in terms of food security, and the fact that it is actually quite a financially self-sustaining SOC, I would be very surprised if the government does not step in to assist it with its short-term liquidity challenges. And I think it is probably short-term in nature. We need to get closer to the land bank to understand exactly what went wrong. But again, I think just given what the land bank does, its mandate, and just how it's conducted itself sort of over the last few years, is quite an investable SOC with reasonably strong levels of governance, etc. I would be surprised if the government is not able to provide some kind of support to assist them in the current time. And I think there's another question on the land bank in terms of government guaranteed debt. So their bonds are not government guaranteed. It's exposure directly to the Rand Bank, so you don't have the government guaranteed exposure. Some of their loans may well benefit from a government guarantee, but again, that is a split that we'll have to sort of based on their latest available financial information, which is now quite stale from 2019. So that's part of what we are busy discussing with the Land Bank at this current stage. But in terms of portfolio exposures, Albert, I don't know if you want to take that question.
Okay, so portfolio exposures vary somewhat. We don't have significant exposures in any one portfolio, with significant being more than 2%. Quite a few portfolios of 0, and stable income is about 1.5% exposure to land bank as we speak. As Corneleo said, it's all senior debt. The other question on stable income performance is just broadly long-term stable income performance and money market performance relative to repo rates will shift as repo rates change, primarily due to the nature of those funds. If you look at long-term expectations, the money market gives you around about 1 to 1.1% return above the repo rate. This is a net annual effective rate. And the stable income fund gives you a little bit over 2% net annual effective relative to repo rate on a 1-year basis. I don't have the precise numbers for year-to-date performance for stable income at our fingertips, but it's in the 1.6% range of returns, maybe a little bit more. I can get those numbers and I will send them out. The repo rate cut, as I said, will decrease the yields. That will happen slowly but surely over the next 2 months or so, as the instruments in the portfolios reprice. As we stand, yields on the stable income, for example, is still a little bit below 8, so I think it's about 7.6, 7.7, but that will start dropping away as a result of the repo rate cuts. And once again, for any clients on the call, repo rate cuts and those kind of things have no capital effect on the funds, so there's no capital losses. Just a reduction in the rate of interest earned on the loans. Yeah, thanks, Corneleo.
Sorry, Albert, there's another question. I'm not sure. Maybe you wanted to add a bit more on that, but if you're comfortable that you've answered it. But it is, again, just the relationship between JIBAR and the repo and prime rate, if you wanted to take that.
Okay. So the repo rate, effectively what it's called is the overnight repurchase rate, right? It's a rate at which repurchase transactions happen between banks and the Reserve Bank, right? Think of it as a 1-day rate. The JIBAR rate that we tend to reference stands for Johannesburg Interbank Acceptance Rate. It's effectively rates that occur between banks. And the 3-month number is because it's a fixed 3-month rate, right? So where the repo rate tends to be a 1-day rate, the 3-month JIBAR rate tends to be a 3-month fixed rate. And as a result of that, it's generally slightly higher, not always, but it's generally slightly higher than the repo rate because you get some term premium for locking down your cash or your capital or your transaction for 3 months, right? The prime rate is effectively the retail version of the JIBAR rate. So whether it's credit cards or car loans or home loans, they tend to happen relative to the prime rate. Prime plus 1, prime minus 1, depending on the underlying asset as well as the risk profile of the customer, right? So if you go back a couple of years and you were a very successful client, so I'm thinking 2005, then you might have been able to get a prime minus 2 loan on your home loan, right? The prime rate is a derivative of the repo rate. So if you think of where prime is for the moment, you take the repo rate and you add a fixed number to that, and you get the prime number. As the repo rate goes down by 1%, so does the prime rate go down by 1%. Those two rates have a fixed percentage between them, and they change perfectly in line on the date of the repo rate change. The JIBAR rate is a 3-month rate, and therefore tends to take into account to some extent the expectation of interest rates, and it's set between banks also daily, but it's then set effectively for any transactions that occur on that day. It's then fixed for the next 3 months. And then the next day, the JIBAR rate is set again. As such, you can sometimes see that the JIBAR rate dip in anticipation of a repo rate cut, followed by further falls in JIBAR after a repo rate cut, as the market prices in the possibility of rate cuts before SARB meetings. So that is generally the relationship between the repo rate, the prime rate, and the JIBAR rate. Thank you.
Thanks, Albert. Then we've got a question here just around staying close to the banks and just seeing how they are viewing the current environment. Yes, so I think we at Ashburton, we are fortunate. We participate both in the listed bond market or listed credit market, but we also have quite a big presence in the private debt market, where we quite often lend alongside banks. So we do get a sense for how they are thinking about different corporates, how they're reacting to different corporates, and to understand sort of their mindsets. So I think it gives us a good understanding around sort of the counterparties where the banks will have a bit more comfort, and where they may not. I think it's also important to then start seeing whether the banks or their funders are running out of patience. And again, because you have quite regular feedback with the underlying borrower or issuer, I think you do have you do get the opportunity to sort of be part of those conversations and just gauge the sentiment. But I think for now, sort of lenders, we haven't observed any sort of difference in the reaction across different lender and investor groups. I think for now, most lenders and institutional investors are likely to remain sort of relatively calm and patient through a time where there's obviously rising uncertainty, with a view to protecting the underlying capital of the exposure. We've got another question. I think there were some concerns around the quality of the feed, Albert, when you spoke around the impact of repo rate cuts on stable income's yield. If you maybe just want to repeat that quickly, just to make sure everyone had a chance to hear that.
Okay. So stable income, as many of you know, is comprised primarily by floating rate notes. As the repo rate falls, the yield on stable income will also fall. It's not a direct one-to-one comparison, because JIBAR tends to fall a little bit in anticipation of repo rate cuts. And after repo rate cut, as JIBAR falls, the instruments in stable income generally reset on a 3-monthly basis. So only when all the instruments have reset to a lower JIBAR will the yield on stable income have fallen to the same level that the repo rate has fallen. As a rule of thumb, however, stable income's average return over a 12-month period is a little bit over 2% above the average repo rate for that period. That is a historic metric that's held relatively well for the last 6 to 7 years, and should likely hold for the next 12 months as well. There might be some slight deviations on a day-to-day or week-to-week basis, but on average, the fund has returned about 2% above the repo rate on a net annual effective basis.
I'm just looking through the questions. I think we've dealt with all the questions. I see there is a question around banks and the decision to suspend dividends. Look, I think the banks are obviously going through the same pressures that all the other corporates are going through. They're going to be faced with potentially rising NPLs, potential reduction in collections on certain of their exposures. So I think the banks will also be looking to sort of shore up liquidity and raise funding at to make sure that they don't have issues of their own. Look, I think the SARB has made quite a few pronouncements which will assist the banks from a capitalization perspective, both in sort of being able to potentially eat into some of the capitalization buffers they have, but also to potentially get some relief on how much capital they have to hold between or on exposures that could migrate into different stages of non-performing. So look, I think there's been quite a few amendments made, and I think the SARB has done well in terms of the assistance they've provided to the banks currently. But I think suspension of dividends is probably the first lever that they can pull from an internal perspective. There are, I think once there are material issues around capitalization of banks, that's when you start looking at potential write-offs of some of the subordinated instruments. But I don't think that is something that that's on the cards quite yet. I think you'll see sort of more measures announced by the SARB if they see a systemic impact on banks, which is starting to place, I suppose, severe stress on capitalization ratios. I don't know if there's anything you want to add to that, Albert.
Nothing from my side. I mean, we've seen no announcements on preferred equity divs being impacted. It is a very small portion of bank funding, but we have so unfortunately there's no information further that I can share.
I think we've come to the end of our questions, so we appreciate everyone's participation in the webinar. As I said, there is one request for some of these slides to be made available, and we can see if that can be done, but that will be in partnership with our marketing teams. But again, thank you for your time and thank you for giving us the time and listening to us.